So let's look at this one. So it says on July 1st, so that's the first transaction, Thomas sold 61,000 of women's sportswear on account. Credit terms are 210 and 45. Cost of goods is 32,000. So I'm offering my customers a 2% discount if they pay me within 10 days. If not, they have to pay it all within 45 days. And I'm the one making the sale. So anytime we're recording transactions for the seller and we have a sale, we're always going to have two journal entries. The first journal entry is to record the actual sale, so the sales revenue and the money coming in, or what's going to be owed to us. And the second is to update inventory balances and record cost of goods sold. So the first thing I'm going to do is record the sale. So I sold it on account, so I didn't get cash yet. I'm going to have accounts receivable, right? And it's for the amount that I sold it for, 61,000. Okay, so 61,000. Oops. Okay, then I'm going to record sales revenue. Sales revenue 61,000. Okay, so that's recording the sale. Then I also have to record updating of the inventory and cost of goods sold. So I'm selling this inventory. That means it's leaving my warehouse. So I'm going to reduce my inventory by the cost of my inventory. Okay, not the price that we sold it for, but the cost. Then I'm going to record it as cost of goods sold. So remember, the cost of our inventory is an asset in the inventory account until we sell it. When we sell it, we record the cost as an expense called cost of goods sold. All right. So now let's get to July 5th. It says Thomas received a $2,000 sales return on damaged goods from the customer, and the cost of the goods was $1,050. So now there was a return that I got because I'm the seller. So anytime we have a return, we have to make a reverse of the entries that we already did to record the sale. Okay, and there's always going to be two journal entries here as well. The first is to adjust for this return. We're not going to directly adjust sales revenue, but rather we're going to have a sales returns and allowance account. Remember, that's a contra sales account that we're going to record the return to, and that's the amount that we sold it for. Okay, the portion that's being returned. Then I'm going to credit accounts receivable because I'm not going to charge them for something that they're not going to keep and return to me. All right. Then I'm going to adjust inventory. With inventory, it's just going to be the opposite. We're going to reverse the initial entry up here for the amount of the goods that was returned. So the cost was $1,050. So I'm going to debit inventory because I'm getting it back in my account, and I'm going to credit cost of goods sold. Okay. You might wonder, it says that it's damaged. So why are we putting it back in our inventory? Well, before we can write it off as a damaged good or do something with it due to it, if we can't sell it or use it for something, we have to put it back in our inventory account first. So just know we're going to do that before we make any adjustments, and that would probably be done at the end of the year. All right. Now let's look at the last journal transaction. It says Thomas receives payment from the customer on account on the amount due less the return and discount. So anytime we're calculating the payment, we first have to figure out what the balance is in our account. All right. We started with 61,000. We returned because we're wanting to know what we're going to pay. Okay, what we're getting as payment. We had 61,000. Then they returned 2,000 worth. So now we've got a balance in there of 59,000. Okay. Well then, let's see, are we in the discount period? The discount's 2% in 10 days. So we're within the 10-day period, okay, because we had the transaction on July 1st. So they're going to get a discount. And the discount's 2%. So this was the balance in accounts receivable. And I'm going to calculate what my discount is. So my discount is 1,180. And so the cash they are receiving is the difference between the two. So 59,000 minus the discount. This is the cash I'm going to get. All right, so when I record my journal entry, I'm going to debit cash for the 57,820. All right, and I'm going to reduce accounts receivable for the full amount of the balance. Okay, because they're settling their account, they're paying me, even if it's not the full amount of the balance in accounts receivable. All right, then the difference, okay, it's a debit, so I'm going to debit 1180 there, and that is going to be called sales discounts. We want to keep up with our sales discounts and our returns and allowances separately because this can give us an indicator of the health of the company. So if we have a lot of sales returns and allowances for a period, or it's drastically increasing, that could indicate a problem with the quality of our products, the design, or something that we need to check to make sure we improve on, or if we're giving too many discounts. We want to keep up with this separately so we can know those things and see those red flags. Okay, so sales discount, just like sales returns and allowances, those are our contra sales accounts. So they have a normal debit balance just like an expense, okay, because they reduce our sales. All right, if you have any questions on this transaction, just shoot me an email or post your question in the Chapter 5 discussion board.